financing a home. For this next section, let's review some of the different loan products that are available. Let's start with the fixed rate mortgage. Generally, this is what consumers gravitate toward because they like security and they dislike change. So that's one reason that the fixed rate program is popular with borrowers. This mortgage will have a higher starting rate, but that's because it will not change for the term of the mortgage. So that's why this product is very popular among consumers. It allows them to predict and plan exactly what the interest rate is going to be, and they won't have to predict any changes coming up. The adjustable rate mortgage is going to have a starting rate or an initial rate, and that starting rate is the interest rate at which the loan starts. So the payment is computed on that. So the payment is computed at that rate based on a 30-year amortization, but the rate can change, and it will change during the life of the loan. These rates could change at different intervals. They might have an interest rate change at 6 months, or at 1 year, or at 5 years. So there's a lot of different options, but keep in mind for right now we're just discussing the starting rate or the initial rate. The next thing to know about would be the adjustment cap. The adjustment cap is the percentage that an interest rate is allowed to increase per adjustment. As I mentioned earlier, typical adjustment periods for most adjustable rate mortgages are after 6 months or after a year, but it definitely could vary based on the investor. With an adjustable rate mortgage, there's always going to be a cap on how much it can increase per adjustment period. There will also be a lifetime cap. The lifetime cap is going to be the highest rate that the interest rate can reach. So for most programs, this means that it cannot exceed 6% over the start rate, no matter what happens to interest rates. But it definitely could vary from product to product. Adjustable rate mortgages use an index, and the index is a published interest rate, and this is what lenders use to determine the new rate. The most popular indices are the 1-year Treasury, the London Interbank Offered Rate, the LIBOR, and the Cost of Fund Index, sometimes abbreviated COFI. So the index is how they base the rate, and sometimes you'll hear it referred to as the basis. Now, the adjustable rate will also have a margin. When adjusting the interest rate, the lender uses the index and adds the margin or the profit on the loan. So some people even call it a profit margin. The margin varies with different adjustable rate mortgage programs, but probably the most common margins are less than 3%. So, for example, a lender might offer an adjustable rate of LIBOR plus 2%. So the loan rate will always follow the LIBOR rate plus 2%, and it will adjust at specific time periods and have a cap on how high the interest could go. The basic balloon program is set up generally like a 5-year or a 7-year fixed rate mortgage with the entire amount of the principal due at the end of the term. And then at that time, the borrower can either pay off the loan, or they will have the option to convert it into another fixed rate or adjustable rate mortgage product. You may even hear these programs referred to as a 525 or a 723, for example, which would refer to the initial period of 5 years in the example of the 525, and the following remaining years set up as a 25-year term. So at the end of 5 years, the fixed rate mortgage is over, and at that time the borrower can either pay off the loan or convert it. Now, you may be dealing with buy-down points. A point is equal to 1% of the mortgage amount. So an easy example is on a $100,000 mortgage, 1 point would be equal to $1,000. The consumer is given the option of paying some interest up front in exchange for a lower interest rate over the life of your loan. Buy-down points may also be known as discount points. So in an example I mentioned in an earlier unit, if you have a home buyer or a home builder who's offering buy downs, the builder would perhaps be paying points. So if the builder is offering a 3% buy down on a $100,000 home, the builder would be paying $3,000 to buy down the interest rate by 3% for a particular period of time. FHA loans are available for home buyers who don't have the ability to make a large down payment. FHA can do this because the government insures the lender against default through the FHA mortgage insurance program. In some cases, the down payment can be as low as 3.5% of the purchase price. FHA loans require 2 insurance premiums. The first is called upfront mortgage insurance, and this is a one-time fee that's charged at closing and almost always is financed into the loan. The second part of the mortgage insurance is a monthly mortgage insurance premium, sometimes called MIP or MIP, and the borrower pays this amount each month as a part of their escrow payments. So it's built right into their mortgage payment. So FHA insurance is a 2-part deal. You have the initial upfront charge, and that gets charged at closing, can be financed into the loan, and then you're going to have an ongoing monthly mortgage insurance premium. Some revisions to the FHA mortgage insurance program were made in 2013. Many clients want to know when the ongoing mortgage insurance will be canceled. So this chart is available in your book on page 174. We hear a lot about credit scores. What you should know is that FHA does not set a minimum credit score. In fact, FHA doesn't even use a credit score to determine eligibility. The lenders are the ones who use credit scores in underwriting. So a lender is allowed to determine a minimum credit score for a program that they offer. This is called a corporate overlay sometimes. Eligibility for FHA financing is primarily based on meeting the affordable debt ratios. Currently, the guidelines require 31% or better on the front end or 43% or better on the back end. Remember that that back end ratio includes all consumer debt that they're carrying. So my experience is that usually that's the tougher ratio to meet. Some other things that you should know about FHA financing are listed here. It's very common with FHA financing for the source of the down payment to be a gift. So for example, a young couple buying their first house, they could have their down payment gifted from a family member. A letter will have to be provided stating that the funds are a gift that will not have to be repaid. With FHA financing, it's not uncommon for the seller to agree to pay a larger portion of the closing costs. Again, this is likely being done because the buyer does not have a large down payment like they would have with conventional or traditional financing. The borrower must intend or agree to reside on the property, so in other words, must be owner-occupied. You've probably heard that term before. If the borrower is not a citizen, they still must show an established employment history and evidence of employment security. So U.S. citizenship is not an FHA requirement. You may have heard about EEMs, Energy Efficient Mortgages. This is a program offered through FHA, and it is useful if a home buyer is interested in doing energy-saving, cost-efficient improvements to a property, and they're allowed to add the cost into the mortgage loan. This could also be done if they want to refinance and borrow additional money to pay for those energy-efficient improvements. The loans can be set up as 15 or 30-year fixed rate or adjustable rate mortgages. The maximum value of improvements that can be added to the mortgage is either 5% of the property value, up to $8,000, or $4,000, so whichever is greater based on the value of the property. Because of this, sometimes the final loan amount might even exceed the FHA mortgage limit, and that would be allowable. So again, the maximum cost of improvements that can be added to the mortgage is either 5% of the property value, but not more than $8,000, or $4,000, whichever is greater based on the value of the property. So the example that we have here is a home with a property value of $75,000 would have a maximum cost of improvement of $4,000 because this is greater than 5% of the property value. So basically on homes less than $80,000, the maximum of $4,000, and for homes valued over $80,000, they are allowed 5%, but not more than $8,000. So once the home value is over $160,000, the loan is going to be capped at $8,000, regardless of the home value. Now, listed here are some examples of improvements that could qualify under the Energy Efficient Mortgage Program. This program could be used to replace a furnace or a cooling system, fix or replace a chimney. Insulation is a very popular use, so you could be insulating an attic, crawl space, even pipes or air ducts. Another popular use would be replacing doors or windows. Installing active and passive solar technologies would also be an approved use. Another loan program that is available is the 203K, or the rehabilitation mortgage. So basically this is to finance the cost of a fixer-upper. There are some restrictions that we will go over in the next few slides, but the intent is to allow a homeowner to finance both the purchase of the house and the cost of the home improvements or modifications. Or it could even be used to refinance a loan and allow the homeowner to borrow money to pay for home repairs. The guidelines to qualify for a 203K or a rehabilitation mortgage are that the cost of the renovation must be at least $5,000, so it has to be a fairly significant amount, and the total value of the property after the improvements must fall within the FHA mortgage limit for the area. So it's always a little tricky to figure out how to project the value of the home after the proposed work is done. So we've given you here the formula that's used. The value is projected to be increased either by the actual cost of the rehabilitation up to a 10% cap on the increased value. So for example, on a $50,000 home, even if the rehabilitation project is $10,000, the value of the property after the repairs would still be projected at $55,000 because of that 10% cap. The types of improvements that qualify for this type of financing is very broad, and it will include many things. It could be alterations or reconstruction to the actual structure. So this could be adding a bedroom or a bathroom. It might be improvements that are done to update the house. For example, upgrading plumbing to allow for a laundry room on the first floor. Sometimes the upgrades are intended to correct an actual safety hazard, such as upgrading wiring or something of that nature. Even improving the appearance could qualify. So even something that you might think is cosmetic could possibly work. For example, adding vinyl siding to a home. Frequently, these loans are done to address plumbing issues, and that could also be a qualifying improvement. Here are a few more examples that could qualify as improvements for a rehab mortgage loan. Adding or replacing roofing, gutters, or downspouts. Adding or replacing floors and or floor treatments. Major landscape work and site improvements. Remember that dollar figure has to be at least $5,000, so you'd be talking about fairly major landscaping work. Enhancing accessibility for a disabled person, or making energy conservation improvements. Now let's move on to a discussion about a newer program, the Back to Work program. As a result of the recent recession, many borrowers who were unemployed or who had a reduction in income found that they were unable to make their mortgage payments. And ultimately, they lost their home due to foreclosure, or they agreed to a pre-foreclosure sale or a deed in lieu. So FHA recognizes that these borrowers faced hardships that impacted their credit history, and as a result, their credit really no longer reflects their true ability to repay a mortgage. So FHA does allow for exceptions to be made. The homeowner must be prepared to provide documentation that the circumstances were beyond their control and that they have fully recovered from the event. And we'll go into a little more detail on these requirements in the next few slides. Now, the first question is, what is an economic event? Well, FHA defines it as any occurrence beyond the borrower's control that results in a loss of income, a loss of employment, or a combination of both. And so they have a reduction in the household income of at least 20% and for a period of at least 6 months or more. So notice that the requirement is that it has to be significant, 20% or more as far as a cut in income, and it has to have lasted for at least 6 months, so not just a temporary or a few month problem. Now the next question is, how do we define recovery? Well, FHA determined that in order to establish recovery, the homeowner must show that for the most recent 12 months they've had satisfactory credit. So the next question is, what's satisfactory credit? Basically, they have to show that if they still have a mortgage, they've kept it current for the most recent 12 months, and do note that a modification is okay and is considered current. And on all of their revolving accounts, they can only have had one 30-day late payment in the last 12 months. So fairly strict guidelines. Basically, in the last 12 months, everything pretty much has to be current, other than they can have one 30-day late payment on a revolving account. Let's move on to a review of VA loans. In order to qualify for a Veterans Administration loan, at least one of the applicants must have completed enough military service to obtain a certificate of eligibility from the VA. This certificate of eligibility is what the borrower gives to the lender so that the lender can fund the loan. Now, why is it advantageous to be able to get a VA loan? Well, because VA backs the loan, lenders are willing to waive the down payment requirement. So lenders can do this because they know even if the borrower defaults on the loan, VA has guaranteed it. So they really have no risk. A lender will make the loan if the Veterans Administration guarantee covers at least 25% of the mortgage. So for example, if the VA guarantees $60,000 of the total mortgage amount, that means the maximum mortgage would be $240,000, or 4 times the guaranteed amount. Now, does this mean that it's a freebie? No, it doesn't, because a VA guarantee fund, a guarantee fee does apply. And here's the formula used to calculate the basic funding fee for present or previous active duty applicants. If the loan is going to be 95% or above on the loan-to-value calculation, the fee is 2%. For loans between 90 and 95%, the fee goes down to 1.5%. And if the loan is below 90% loan-to-value, the fee is set at 1.25%. This fee can be financed into the mortgage, and most commonly it is financed into the mortgage. The VA guarantee rate varies for refinances. So in a refinance situation, it's important for the borrower to check with a lender for the calculation of that fee. The last type of loan that we're going to be discussing in this section is the Rural Housing Loan. The United States Department of Agriculture, the USDA, insures loans that may only be offered in non-urban areas. And you should note that the definition of a non-urban area is updated annually. As you can imagine, many areas that previously have been defined as rural have been built up, have had an increase in population, and would no longer be considered a rural area. Generally, this designation is based on the population of the area. So as more people move to an area, it could certainly lose its designation in order to qualify as a rural area. Rural Housing Service loans are similar to FHA in a lot of ways. The difference is that the capital used for the loans may be from Rural Housing Service, or it may be combined with funds of a private lender. What's great is that the interest rate on these loans from Rural Housing Services is very low, and it's based on the household income of the borrower. So what you'll find in many cases is that these RHS loans are the only way that some low-income households are going to be able to qualify for a home loan. In your books on page 178 and 179, we have provided a comparison chart so that you can compare programs, and you can take a look at that chart for additional information. The final review item in this section discussing financing a home is that you do have to be careful to avoid any conflict of interest or even the appearance of a conflict of interest. Counselors are only to provide information and not to promote any particular loan product or program. HUD dictates that counseling must include a reasonable discussion of alternatives and options available to the client. To accomplish this, counselors may discuss specific products, features, properties, or programs, but if you're going to provide information about a specific for-profit program, you must provide at least 3 other options. So you have to make sure that you're providing at least 3 reasonable and comparable alternatives. And at least one of these alternatives must be an FHA product. Any discussion of alternative options should be documented in the client file. Remember, counselors must not advise clients. Our role is to make counseling recipients aware of their options and empower them with the information they need to make smart and informed choices on their own. Thank you, and this concludes our discussion of Unit 5.3, Financing a Home.